Incomplete records. How to start and finish studying. Have a bird's eye view of the entire syllabus. Study each topic thoroughly. Work out examples, illustrations, and exercises. Repeat until you understand. Practice exam questions. Practice mock exams. Simulate exam conditions and practice. In this lesson, we learn everything about what is incomplete records, concept of calculating profit from incomplete records, how to value inventory, International Accounting Standard IAS2, markup versus margin, profit and cost versus selling price, how to calculate the cost of inventory, loss by fire or theft. Altogether, we discuss and practice questions based on these concepts. Identify and practice examination problems. Incomplete records. Sometimes businesses, a small business in particular, do not maintain a full set of accounting records. This means that a trial balance cannot be drawn up and financial statements cannot be prepared until a certain amount of preparatory calculations have been carried out. Much depends on the records and information available as to whether a full set of financial statements can be prepared. Advantages of maintaining double entry records. Maintaining a full set of double entry records is important, provides many benefits. These include the following. Full details are available about the assets, liabilities, revenue, expenses of the business. The preparation of financial statements is relatively straightforward. The calculation of the profit or loss for the year is likely to be reliable and accurate. More informed decision making is possible. A greater degree of control over business activities can be exercised. The possibility of fraud is reduced. Comparison with the results of previous years and with other businesses are possible. Detailed records are available for reference purposes. Information required by a bank or other lender is readily available. Statement of affairs. The only records available are those relating to assets and liabilities of the business. It is not possible to prepare an income statement. These assets and liabilities are listed in statement of affairs, which is similar to statement of financial position. When a list of assets and liabilities is prepared without the use of set of double entry records, it is known as a statement of affairs rather than a statement of financial position. Formula. If the assets, liabilities and capital of the business are known and no further information is available, the only way in which profit can be measured is to compare the changes in the capital over the financial period. Capital increases when a profit is made and decreases when a loss is incurred. The basic formula for calculating profit is closing capital minus opening capital is equal to profit. Part of the difference between the two capital figures may be caused by drawings made by the owner. If drawings have taken place during there, the formula must be modified to closing capital minus opening capital plus drawings is equal to profit. If additional capital has been introduced during this, will also be account for some of the difference between the two capital figures. The formula must be modified to closing capital minus opening capital plus drawings minus capital introduced is equal to profit. Cash discount. Allowed and received must be included in calculations of credit sales and credit supply purchases. The discounts must also be recorded in the profit and loss section of the income statement. Markup, margin and inventory turnover. When dealing in incomplete records, sometimes necessary to use percentages to calculate missing information. Markup and margin. These both measure the gross profit as a percentage. The markup is the gross profit measured as a percentage of cost price. The margin is the gross profit measured as a percentage of selling price. Rate of inventory turnover. It is sometimes necessary to use calculations relating to rate of inventory turnover in order to calculate an unknown figure in the trading account section of income statement. The rate of inventory turnover is the number of times a business replaces inventory in a given period of time. The formula for calculating the rate of inventory turnover is cost of sales upon average inventory.